Hi everyone, Megan Marsh here in Erie, Pennsylvania, bringing you your most recent mortgage information. What I wanted to talk about today was shopping for your mortgage, shopping for your interest rate. This is one of my favorite things to talk about, being at a mortgage broker, and I want to give you an example that will help you understand why it's so important not to just look for the best interest rate. It's one of my favorite things. I get phone calls all the time in the office. Somebody will call and I'll get on the phone and they'll say, well, I'm calling around town and I want to see what your interest rate is. And unless you're putting 20% down, you shouldn't just be shopping for your interest rate. And I'm going to give you an example here as to why, and I think you're going to see the benefits, the pros and the cons of looking at the whole picture, not just what's your rate, what's your rate. Remember when you call for interest rates, and it's important to look. You should look, and you should look at what your options are. You should shop for mortgage. You want to make sure everyone's cost should be pretty comparable. The difference shouldn't be that much in cost. If you notice that someone's costs are a lot less or a lot more, there's something missing there. Everyone should be pretty comparable. When it comes to interest rates, you're probably going to find too that most people's rates are going to be within 1/8 to 1/4% of where the next place is. I personally feel that usually if you do go to a broker, your rate will be about 1/8 to 1/4% less. Remember, when you're listening to interest rates, is it being quoted with an origination fee or without an origination fee? An origination fee is 1% of your loan. So if you have a $100,000 loan, that's $1,000. And some places will say our rate is 5% without an origination fee, with no cost. Or the next place might say our rate is 4.75 with one origination fee. That's $1,000 added onto your cost. So keep that in mind. Here is a little chart that I put together, and I'm going to post this underneath my blog for you to look at so you can kind of see the details and the numbers in case it's difficult to see. And I have really horrible handwriting, so I apologize. I tried to do the best I could. But I wanted to give you this example, and I did this with my sister when she bought her house a couple months ago. And I'm going to show you the one she ended up going with. But if you call in and you say, oh, what's your interest rate? I'm doing it on a $250,000 house, putting 5% down. So that makes your loan amount $237,500. So I'm going to go through the 4 different programs. And I actually have 1 or 2 more, but I was trying to keep this as simple as possible to start off. So you have your regular mortgage insurance loan, because when you're putting 5% down, you're going to have some type of mortgage insurance on that loan. And mortgage insurance is insurance that the bank collects because you're not putting 20% down. So you have your regular MI loan, what most banks offer. If you were to call most local bank, national bank, this is what they're going to offer you. Okay, so I did, all right, the regular rate. So if you were calling me, I'd say, oh, our rate today is 4.875. That's what it was last Thursday or Friday. Your principal and interest payment is $1,256. Your mortgage insurance amount at the regular rate is $186. That makes your total payment $1,442. And over the life of the loan, you're going to pay $471,820, which is really scary when you look at how much you're borrowing. But let's go to the reduced mortgage insurance. So we have one of our multiple lenders has an option where you can get reduced mortgage insurance monthly. Look at this. The rate's slightly higher. It's 5% versus 4.8%. So your principal and interest is slightly higher. But look at the difference in the mortgage insurance. It's $122 versus $186. You're saving close to $60 a month. So your payment now, instead of being $1,442, it's $1,396. So if you were to call and not understand this, you would say, oh, what's your best rate? Okay, this is our best rate, but it's not our best payment. So let's look at the next one. These two are specialty products. And, I don't think as many places offers these products. So this is a good one to look at. It's called an LPMI, Lender Paid Mortgage Insurance. So what they do is instead of charging you mortgage insurance, they increase the rate. So look, rate goes up to 5.25 now. Principal and interest goes up to $1,311. There is no mortgage insurance. Look at this payment. It goes down to $1,311. You're talking $130 less for this mortgage payment here. But if you look, to get the whole picture, you're still paying about the same over the life of the loan. Because what happens is you're saving that $140, $150 in the first 9 years when these two have mortgage insurance. Once it drops off, rate's a little bit higher. So it starts evening out. So really, you can't go wrong with this loan if you keep the house for even 20 years. It's not till the last 5 years that it catches up and it becomes completely even with this loan. But if you know you're not going to be in a house for 30 years, even if you think you might be there 20 years, you want to go with these options because you're going to save that $130 a month for the first 9, 10, 11, 12 years. And then my favorite one, this is the one my sister picked, which she was not aware of until I went through this with her and I made her ask her lender to look at this. She lives out of state. It's called BPMI. It's the borrower paid MI. It's financed into the loan, or you can pay it up front. So rate is the same as if you got regular mortgage insurance. So the payment is $12.81, a little bit higher, because what happens is you pay a percentage up front. It's close to, on this loan, it's close to $5,000. And it gets financed into the loan amount. So the loan amount's a little higher. It's $242 versus $237. $12.81 is the payment. Zero mortgage insurance. $12.81 compared to $14.42. I'm just going to do this on my calculator because I didn't write it down. $14.42 minus $12.81. That's $161 a month that you're saving. And if you look at it this way, this one actually saves you the most over the life of the loan. It's $461 versus $471. But let's for 1 second look at the first 9 years. In the first 9 years, my sister will be saving $19,344 in the first 9 years. And to add on to that, to give you a little tax tip, because I used to be in accounting and I like looking at tax things, if you, as a family, are making over $100,000, you cannot write off any of your mortgage insurance. Can't write it off at all. But you can write off all your interest on your loan. So in the first number of years, with the LPMI, where the rate's higher, or with the financed MI, you're saving an additional $5,800 that you'll get back on your taxes because you can write it off. Whereas the people who go with mortgage insurance can't write it off. They're just giving it to the bank because that's one of the tax laws. So I hope this is helpful. I want to stop here. We'll talk about this a little bit more on one of our next blogs. I'm going to post this once again underneath the blog, but I wanted to give you an idea of why you shouldn't just shop for your rate. You need to shop for your loan program, and you need to look for somewhere who offers a lot of programs because there's a lot of benefits to having many options. Once again, this is Megan Marsh in Erie, PA. If you have any questions or comments, email me at Megan, M-E-G-A-N, @selectmortgageerie.com. Thanks for listening, and come back next week.